Hello, traders. Gary Wagner here. It is 11:50 in Honolulu, 4:50 in New York on Thursday, 10th day of November 2022, and this is the Daily Report for gold and silver. Today, the government released its most current figures on inflation through the CPI for October. It revealed that inflation, which was perceived to come in at 8.09%, this by the Federal Reserve Bank of Cleveland's modeling system, that changed the probability that the Federal Reserve will begin to ease up, and the December rate hike most likely will be a 50 basis point or a 0.5% rate hike rather than a 0.75% rate hike. In fact, the probability for a 0.5% rate hike, according to the CME's FedWatch tool, went from about 58% up to 80% in a single day. Gold took off like a rocket, currently up $44.30, a gain of over 2.5%, with the most active December contract fixed at $1,758. The low today was $1,705, and it did not look back from there. Obviously, we had an open order in to buy just below 1,700. We sent out a trade alert to do a cancel and replace. All of that is on the members page, as well as the trade alert you received by email. Now, the biggest component in terms of the change of gold pricing, up 2.59%, was the fact that the dollar was down 2.5%, almost equal to the rise in gold. In fact, it was only slight buying that pushed gold up this massive decline that we saw in the dollar index, now fixed at 107.705. Lastly, silver gained about 2%. That doesn't even cover the dollar weakness at 2.5%. It gained 1.98% with the December silver contract currently fixed at $21.75 after factoring in today's gain of just over 42 cents. First, to our current trade alert. As you know, we sent out a trade alert the other day. We were looking to buy just under 1,700 at 1,696. That occurred after we had this big sizable jump and the market kind of settled down right at around 705. We thought we might be able to get in at a dip a little bit lower. Today's CPI report changed everything. The market spiked higher to the tune of over $40. And so what we did is sent out a trade alert to cancel and replace your existing good till canceled limit order. The new order should read to buy December gold at $1,743 as a limit order, good till canceled, and move your stop up, a good till canceled stop. It's a very, very small risk, as you can see, about $5, $6, because our belief is if we do get a real retracement beyond this point, we would look to re-enter the market just a few dollars lower below the 23.6% retracement, and then we would have to place a stop just below the 38.2%. But we're hoping that we get a small dip, enough to fill our order but not stop us out, and then a return to the upside. Because traders, we are getting extremely bullish, and the reason that our market sentiment has changed so much is inflation is still running exceedingly hot. Even though it came in under expectation, the expectation was a little over 8 and it came in at 7.7%. 7.7% inflation is nothing to get excited about. It's still exceedingly hot. It's still exceedingly persistent. And in fact, when you look at the details of the CPI report, food and energy costs actually rose this month when compared to the prior month. So for that reason, we feel as though going in through the rest of this year and into next year, we could see a sizable rally in a couple of the financial markets, meaning the equities markets as well as gold, running in tandem to the upside. We are looking at a 30-minute candlestick chart of the dollar index because it was dollar weakness that provided 2.45% in terms of a net decline, and gold only increased by 2.64% as of current pricing at $17.59. That means that only 0.2% were due to market participants buying, but well over 2.4% was directly responsible to dollar weakness. And you can see that right here. The report comes out and we see a dramatic decline in dollar value and a small tick up and then a further decline. As I said, the dollar index is currently at 107.755. The biggest declines came in the 10-year notes, down 7.76%, and the 30-year bonds, these are on the futures markets, down 5.53%. Yesterday, I published my long-term forecast for gold going to Q4 of 2023, the end of next year, and I'm forecasting that gold will hit a new price, $21.81 being the minimum. Realize that when I'm looking at this, we're using our weekly charts, and this one line that's extended from these lows of 21 all the way up to our first level, $2,181, is going to be a series of stair steps. Lastly, I want to look at a daily chart that has the 50-day moving average. We've obviously barreled right through that, as well as a Fibonacci retracement data set. The data set begins from this recent top at 1824 down to the lows of what I'm calling a near triple bottom. They're very close, but they're not exact. We can see that today's move began above the 61.8% retracement, barreled past not only the 50, but the 38.2%. You notice these two little red lines right here and here. Those were drawn in when we actually had a void or price gap. This gap was created from going from one contract month being most active to the next forward month. And that seems where we could find resistance. Absolutely, I would expect some at 1775. Of course, as I said, we placed an order much closer to where the market is. We're hoping that the market comes down, fills that trade for us, and then at least challenges 1775, if not $1,800 per ounce. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.